What's up everybody? So literally one of the easiest ways to have made money in 2020 was to have invested in the EV sector, with companies ranging from behemoths like Tesla to small SPAC startups like CIIG seeing triple-digit growth. But there was one company that beat them all. That company's name is NIO. And today we're going to analyze whether this is a company who you should be investing in 2021. So who are NIO? NIO is a pioneer in China's premium electric vehicle market. They design, jointly manufacture and sell premium electric vehicles using next generation technologies in connectivity, autonomous driving and artificial intelligence. Although they are headquartered in Shanghai, China, they truly are a global startup with their design team in Munich, their software team in Silicon Valley, and their vehicle performance team in London. Founded in 2014 by William Li, NIO first started not as a consumer EV developer, but by building the world's fastest autonomous supercar, the EP9. It had a top speed of 350 kilometers an hour and can do 0 to 60 miles an hour in 2.7 seconds, receiving worldwide acclaim, most notably from Richard Hammond on the Grand Tour show on Amazon. So NIO launched their first mass manufactured EV, the ES8, a premium 7-seater aluminium alloy body, on its NIO Day in December 2017, and began making deliveries for this from June 2018. This vehicle has a range of 580 kilometers and starts at $65,000. They then launched the ES6, a 5-seater high-performance premium electric SUV in December 2018, which has a range of 610 kilometers and starts at $52,000. Then came the EC6, a fully electric mid-sized 5-door luxury crossover SUV announced in late 2019, which has a range of 615 kilometers and starts at $53,000. Finally, they literally just launched its first luxury sedan, the ET7, at their 4th annual NIO Day in January 2021, which was primarily to compete with Tesla's Model S. The EV market in China is still in an early adoption phase, with battery recharging still a major issue for all EVs. However, also developed a variety of innovative charging solutions and comprehensive value-added services, which include Power Home, their home charging solution that allows a 20 kilowatt system to recharge a NIO battery in as little as 3.5 hours, right at your own home. Power Swap, their patented drive-in battery swapping service, which allows customers to swap their empty battery for a fully charged one. This service costs around $150 per month and gives them 6 swaps per month. Not only is this service quick and can be done in as little as 3 minutes, but automatic battery and electric system checks are performed during each swap to keep the vehicle and battery in its best shape. This is a big differential from its main competitor Tesla, something which Tesla has previously stopped doing. Power Mobile, their mobile charging service, where with one click through the NIO app, NIO will come to charge your car on the spot using its charging trucks. And finally, Power Express. Again, access through their app. This gives their customers the ability to have a specialist come and pick up their car, charge it and then drop it off, all within the shortest amount of time, 24/7. Nevertheless, NIO has used battery swapping to its cost advantage. China's subsidies generally only apply EVs priced around $45,000. However, there is a vital exception granted to vehicles built with battery swapping technology. This therefore allows NIO to price its vehicles in the premium category, still whilst receiving potential subsidies for their clients. Like Tesla, NIO does not just sell a car, but rather an identity or social status. The level of engagement between NIO employees, no matter their position, and their users is unprecedented. Each year, for example, William Li travels to different cities to host fan meetings and talk to NIO users. This has led NIO customers to follow the company with cult-like status, leading to excellent user experience scores. Put simply, clients love NIO. This was best shown in 2019 when the company was struggling financially. Here, one NIO user in Shanghai voluntarily spent $460,000 of their own money to rent 10,000 TV screens in the back of local taxis to promote NIO. There have been other stories of other owners volunteering for a day as a salesperson in their local NIO store to help increase sales. And finally, one owner from the Hunan province invited over 400 people to come and test drive NIO's EV through the NIO app, resulting in a large revenue boost for the company. The reason why customers are so loyal is because NIO is redefining the user experience that is centered around putting the customer first. They don't sell their cars in soulless dealerships like we see here in the West. In fact, they sell directly through their own sales network. Their first channel is their NIO House, which are not only their showrooms, but a clubhouse for their users with multiple social functions. Here, owners can simply come to have a coffee and chat about cars with other NIO owners, with no pressure to buy. In fact, NIO's attention to detail is so fine that they will spray paint a model to the exact car color that you want, so that you are getting the full user experience before buying. Secondly, they use their mobile application, not just to allow their users to command their vehicles, but also allowing them to engage with their community, helping to develop dynamic and an interactive online platform. In fact, NIO believes that it is this combination of online and offline experiences, whether over a cup of coffee, through using the app, or attending the annual NIO Day, which will retain users' engagement and cultivate loyalty to their brand. In my opinion, one of their greatest strengths is its management. Normally in my videos, I like to talk about the entire management team, but today I just want to focus on its chairman and CEO, William Li, for you to truly understand what is special about NIO. So William came from an impoverished background, living in Anhui, rural China, with very humble roots. His parents were hardworking, saving all of their money so he could attend university. Li attended Peking University, where he achieved 3 undergraduate degrees in sociology, computer science, and law. He started his first business, BitAuto, an online car review platform, which became China's #1 marketing platform for purchasing used cars and generates over 1 billion in revenue per year. Li sold this in 2013 and then went to start the Xpeng Group, which is a small consumer automobile finance company, which he eventually took public on the Hong Kong Stock Exchange in 2017. By the time NIO started, he was already a billionaire, and he is now valued at over $7.7 billion. NIO is also backed by China's elite entrepreneurs, including Pony Ma, Tencent's founder and CEO, Richard Liu, JD.com's founder and CEO, Li Jun, Xiaomi's founder and CEO, plus William Li himself. It is this stable of backers, plus the expertise and drive of Li, which I think is a key component of the company and why I'm so bullish on NIO and its future. Key ingredient for NIO's surging share price is the size of the opportunity that they have in front of them. The Chinese electric vehicle space is booming, with China-based manufacturers accounting for over 50% of global EV deliveries. Demand for EVs within China is likely to remain strong, as the Chinese government announced that it wants around 25% of all new cars in the country to be electric by 2025. Something that it is pushing with its NEV subsidy program to incentivize consumers to purchase vehicles from companies like NIO. With a population of nearly 1.4 billion, China had over 1.2 million EV car sales in 2020. So it's a big piece of the pie that so many companies are fighting over. The opportunity is therefore massive. On the 1st of March 2021, NIO announced their Q4 and end of year financial results. I'm just going to give you my 5 major takeaways. The first thing was, delivery growth is strong, with NIO delivering 43,728 vehicles in 2020, which is up 112% from 2019. In total, revenues were nearly $2.5 billion, up 10% on 2019. More deliveries have also improved NIO'S vehicle margin, and this is now around 12.7%, up from 9.9% in 2019. They're still not profitable, but they are showing signs, and it is forecasted to become profitable within 3 years. Currently, their loss from operations was $706 million, down 58.4% from 2019, and non-GAAP net loss was $784 million, down 53.3% from 2019. In fact, cash position has now increased to $5.9 billion at the end of 2020, up from only $863 million in 2019. This has ultimately come from increasing debt. NIO has been able to take advantage of its surging share price by refinancing, and in January 2021 it issued $1.5 billion of convertible senior 2026 and 2027 notes. In fact, borrowing trade note payable and long-term borrowings total $2.1 billion. However, I believe that with a debt-to-equity ratio of just 24.7%, this is more than manageable. All of this should therefore give them enough cash runway for another 3 years. So I believe there's enough cash in the company for them to scale up, deliver more vehicles, and increase their margins. NIO is clearly a company that has it all: an inspirational leader, premium products, innovative services, and a devoted fan base. But they are arguably in the EV market at the right time. All of this has seen NIO's stock price surge by 2,100% in just 1 year, setting a 52-week high of just under $67. Something quite amazing when they appeared to be teetering on the edge of bankruptcy for months after burning through over $6 billion in funding since 2014, before getting bailed out by the Chinese government. Its share price is now around $45, giving it a market cap of over $70 billion. This means that it is now the second largest car manufacturer by market cap in China. And this is crazy when you think companies like Ford and BMW are valued at just $50 billion, and they ship a lot more cars than NIO does each year. The share price has been extremely volatile compared to average market volatility, exemplified when it fell by 30% in recent tech market sell-offs, blowing past previous support levels. If we want to purchase NIO stock, we must consider at what price we are prepared to enter in at, as unlike traditional value stocks, this, in my opinion, is a simple speculative play, and so it's quite difficult to calculate its true fair value. The first major threat are existing domestic and international competitors. Its first main competitor is Tesla, the world's largest car company by market cap, and the most famous EV manufacturer. Led by the even more enigmatic Elon Musk, Tesla's quest for world EV domination runs through China. The Chinese market is huge for Tesla, with its 2020 revenues being $6.7 billion, which is double what they achieved in 2019 and represents around 21% of their total sales. Tesla has been aggressive in China, not just ramping up production at its factory in Shanghai, but by also pricing its cars at a very competitive price. This has been a real success story in China, as Tesla far outpaces NIO in terms of sale of vehicles. And in fact, its Model 3 was China's best-selling EV car in 2020. If Tesla continues to scale, it will be able to produce its cars not just faster, but with higher margins, putting further pricing pressures on NIO, especially when the market matures. But Tesla is not just the only international threat. And despite NIO's loyal customer base, Chinese consumers like buying SUVs from international prestige brands, especially from companies like Mercedes, BMW, and Audi. So there is the risk that NIO may be perceived as something less aspirational by Chinese consumers, which could impact the future sales. Then there's also the risk of other well-known international brands like Ford, General Motors, Volkswagen, or Toyota also getting into the EV space and taking a share of the Chinese market. It is well known that batteries are the most expensive component of any EV. With this area seeing huge developments year on year, there's a real risk that an existing player could develop or partner with a strong battery offering to offer a new EV car in the Chinese market. There is also the real risk of domestic EV competitors such as Li Auto and Xpeng taking market share away from NIO. Nasdaq listed Beijing-based Li Auto started in 2015 and offers just one vehicle, a luxury plug-in hybrid crossover SUV called the Li Shang 1. The company's strategy appears to be paying off, as this car, which is priced around $46,000, is one of the country's top-selling SUVs. Li Auto is trying to corner a specific side of the market and act as a bridge between people abandoning their traditional cars before diving headfirst into fully electric vehicles. Guangzhou's Xpeng started in 2014 and is also on the Nasdaq. Xpeng produces and sells premium electric vehicles, including their G3 SUV and P7 four-door sedan, which are positioned to compete against Tesla's Model Y SUV and Model 3 sedan. These are more affordable, and the basic version of the G3 costs around $22,000 post-subsidies. Although NIO delivered more vehicles than both of these local competitors are closing the gap. And in fact, Li Auto's growth of both vehicles delivered and total sales grew faster than NIO's did in 2020. And it's not far behind them in total numbers too. They are really catching up NIO and may be a very credible competitor in future years. There are also non-competition threats that could impact NIO. The battery swap is an amazing technological differentiator for NIO. But can they make it into a viable business strategy? The battery is the single most expensive component of an EV, costing around $10,000 US. And this technology is in a rapid state of development. So many manufacturers have been reluctant to standardize their battery due to these changes. And this is something which we saw when Tesla stopped their battery swap technology in favor for its supercharged stations. NIO, on the other hand, is standardizing their battery, which could put them at a massive disadvantage if the technology changes. There are also limited battery swap stations across China, with currently just 160 for NIO, whereas there are over 300 supercharging stations for Tesla. Hence why NIO are so aggressively pushing other forms of recharge. The risk is that there is not just the infrastructure in the country to support the EV growth. Yes, this will come, but if this is slower than the rate that companies like NIO are producing EVs, there's an increased risk of waiting for your car to be recharged, or cars simply running out of electricity on the road, which could lead to lower levels of customer satisfaction. While the company has scaled up production, it hasn't come without its challenges. It recently recalled 5,000 vehicles last year after reports of multiple fires. Although this is happening across many EV producers, this could have an impact on future sales and customer satisfaction. As it's China, we have to consider politics. Currently, the Chinese government has been a big backer of NIO, stepping in when they were going to go bankrupt and offering them a $1 billion bailout. This didn't come for free, and in return, NIO had to commit its core businesses and assets in China, called NIO China. Although they have recently paid this down, if NIO doesn't hit a certain benchmark, or they decide to take NIO China public, the Hefei investors can cash in their shares at an 8.5% premium. What's more, if this happens and NIO is able to pay them back, the Hefei investors can force NIO to sell its stake in NIO China. So in conclusion, NIO is clearly an innovative business with a spectrum of products and offerings. They're competing in a market that's only going to grow, and it appears to have the current backing of the Chinese government for now. NIO currently trades at 15 times projected 2020 revenues, so it could be considered as a little overvalued today, even after the recent pullbacks. I have bought in and sold NIO twice before, generating a 20% return already. I like the company and I will be investing in the future. I do own some stock cost average of $42, and I will be looking to increase my holdings when there's further volatility. However, I don't subscribe to the view that NIO is going to $100 by the end of the year. Not because they're not a good company, but because it's a very speculative market at the moment. With a lot of competition, this stock has seen tremendous growth in the past year, and to double their current share price in 8 months would give them a market cap of over 150 billion, which is something I just don't see happening. But I do believe this company will provide us traders some short-term opportunities to trade in and out of the stock, because I do believe that this stock gets overbought and oversold quite regularly. I am happy to hold this stock in the long term, and I will look to make some further purchases around $40. But what do you think? Do you think the stock is currently massively undervalued, or do you think there's more pain in store for NIO? Please feel free to leave me a comment in the section below, and don't forget to like and subscribe. I do reply to all comments. I'll be working on a number of videos, so if there's any companies that you want me to review, please let me know and I'll do my best to do it. Take care and have a great day.